All right. So in this episode, we're going to go a slightly different direction. So we usually talk about e-commerce and, investing in e-commerce and marketing in e-commerce and all the things you could do in the e-commerce world, especially in the Amazon side of things. But today we're going to be talking with a friend of mine about real estate investing. And so I'm super excited to bring on James May from J-Core Investments. So James, first off, thank you for coming on Maximizing E-commerce.
Well, thanks, Kevin. Thanks for inviting me. It's good to reconnect with you after so many years.
Yeah. So that's the interesting part here is you and I go back to literally the Reagan administration. So we're kind of dating ourselves here, but we go back to what, third grade?
Yeah, second or third grade.
Yeah. When did you move to the same elementary school?
Yeah, second grade.
Okay,
yeah.
So second grade. So then, so I knew you from second grade all the way through high school. We even worked at the same McDonald's for a while. We've kept in touch over the years. So, so we've crossed paths many a times over the years. So super excited to reconnect. And so, tell us a little bit about how did you get to this stage here? So, like, what happened after high school?
Yeah, so I guess that's where we probably lost touch. Is I went off and joined the Marine Corps, and went and traveled around the world for 5 years. And then after that, I got out of the Marine Corps, tried the corporate world with MCI for a few years and said, no, this isn't going to work. So then I jumped back over to the government and joined the US Department of State, which is a lot of people don't know about, but it's our foreign service. So basically working at embassies all over the world, about every 2 or 3 years, moving around. So, I've lived in Israel, Rwanda, Indonesia, Japan, Cyprus, went back to Israel, Washington, D.C., and now I'm here in Florida with you.
Yeah. So we're like a little bit more than an hour away from one another now. In fact, as we're recording this in mid-December, we had just had lunch at Panera because you were coming back from a real estate conference, which is really more the gist of where we're going with this. But yeah, so you've lived quite the adventurous life. I mean, I think a lot of people would just be jealous of the fact that you live in Fort Lauderdale, but you've literally seen the world. In fact, I remember reconnecting with you sometime in the 2000s, and I forget the country you lived in. And at the time, I'd never heard of it, and I don't think I've ever heard anyone mention it since. But you were working at like the embassy or something, like doing internet stuff.
Yeah, that must have been probably East Timor. So
okay,
just right above Australia. So yeah, it's a little country no one knows about, but we did almost 3 years there. But yeah, it was a good time.
Wow.
Yeah.
So you were in the Marine Corps, which coincidentally last night I had this dream that I had joined the Marine Corps, and I was just thinking like, wow, everyone's like so nice. But I realized
that wasn't it's not that way now.
No, I'm probably too old to join the Marine Corps anyway. But so that could be a conversation for another time, what your boot camp experience was like. I've always kind of wondered, having not been in the military. But what I am kind of curious about is what led you into real estate. So it sounded like you had like a pretty safe government job. So you were in the corporate world, you left that and you went to the government. You were working for, the US government, which you still do. And these are not jobs that, like, if you look at your boss sideways, you're going to lose your job necessarily. Is that a fair statement?
Yeah, I guess it's a fair statement. You might, what we call a curtailment, get kicked out of a country. The ambassador might tell you to leave, and then you have that corridor reputation, which definitely hurts your onward assignments and et cetera, et cetera. But so it's been a great job, and that's kind of reason probably why I was able to be so successful also in real estate, at least learning as where I've gotten to now, just because living overseas, a lot of the expenses are covered, just like in the military. Our housing is covered, so basically that gives me a lot of disposable income that I could start putting in real estate. So I guess I'd go back to probably 2005, and my mom, I'll give her credit. I always give her shouts out that she's the one who got me into real estate. So basically,
and your mom, was she like a real estate investor as you were growing up? I already know the question.
No. It was just a random comment she made. She was driving through Frisco,
which is in the Dallas area.
Yeah, so where Kevin and I are both from, and just like, hey, there's this new development going up in Frisco. You should maybe look at it. She knew I was looking at property, but I didn't know anything when I was doing that. So make a long story short, don't know anything about mortgages, don't know anything about property management, rental, et cetera, et cetera. And I just basically bought a piece of property up in Frisco, Texas, a townhome, which I still actually own.
Oh, wow.
So this is pre Bigger Pockets, for those that know real estate podcasts,
Uh-huh. Uh-huh.
pre, well, let's even say pre all podcasts or anything out there.
Right.
And I'm just kind of fumbling through it as I go, and I'm learning how to do a mortgage, how to hire a property manager, how to get a renter, and all that. And in hindsight, I was just like, oh, I'm just happy to own the property and call myself a landlord. I didn't know there was supposed to be like cash flow and stuff, so I was just happy to be breaking even. So you fast forward that, doing that a couple times and a lot of other stuff, there's a lot more I've learned on how to do the real estate. That was on the single family. And now even fast forward to today, where we're at right now is I'm actually in multifamily syndication real estate. So that's a whole different can of worms, I'll say. So what multifamily real estate is now, I'm looking for investors that come in and invest with us. So we're taking, $12 million deals down, $25 million deals down. The difference with that is, I can't do that on my own. You're going to need a lot of, upfront capital to do that. So, and I know I skipped quite a bit through that whole story, but that's kind of
We'll unpack it.
Yeah, unpack it there. So yeah, so that's where we're at today.
Well, let's go back to 2005. So some people might have heard me tell this story before. I don't know if I've ever told you this story. So my first attempt at e-commerce was in like 04, 05. I bought some Nike Forwoods, which are golf clubs, on eBay. And my research at the time was, oh, they're selling on eBay for $40 or around there. And if I go to Nike.com, the manufacturer's suggested retail price was like 400. So it's like, oh, I can 10x my money. Yeah. Didn't really think to like, okay, are other people paying $40 too? Am I just lucky that I landed on eBay at this time? And so the market really was about $40 for this golf club.
Yeah.
So I still have two of them. One of them's still in the packaging.
Maybe they've appreciated over time.
Exactly. But I did what the mistake a lot of people that make is when they're not sure, they just do nothing. And so I lost out from 04 to 05 until 2015 before I got into e-commerce, because back then there wasn't podcasts. Yeah, there was internet, but like, it's like, you could go on like earthlink.net and maybe somebody has like, you wouldn't even call it a blog post. It'd be like an article or a forum on AOL or something like that, where people were talking about it. So where did you start learning this stuff? Was it like Rich Dad, Poor Dad? Like, like, how did you, like, at a certain point, you're like, I've got skin in this game, so I have to figure it out.
Yeah. Well, I think I think you said one thing that definitely resonated with me is just keep trying and learning as you go, take action. So then probably a year later, I bought another property and kind of figured out a little bit. I was like, well, hey, if I can squeeze this expenses or, get the closing down or something, then I'm making a little bit more, profit on the cash flow. And the goal is, it's on the single family homes, in my opinion, you're not going to be making, you're not going to get rich quick on this. So really what you're doing is you're just letting the renter pay down the mortgage, and you hope to have a little bit of cash flow coming in. So, usually what I'm trying to look at is like around, $200 a month in cash flow, and about 10%.
After all expenses.
Yeah. After all expenses, it depends on, how much you put down. So there's some, ways I look at, how much I'm going to put down in that one property. But to make a long story short on that, I quickly learned over, I did that for almost 15 years, got up to 13 properties that we actually still own, single family, and it got too cumbersome to manage. There's 13 properties across the United States, different property managers, and it just got too much to handle. But I still loved real estate. So I was like, well, I want to learn more. And this is now where the Rich Dad, Poor Dad comes out, the podcast comes out, and all that. So I was like, well, what else can I do? And I was actually in my last assignment in Israel. This is pre-COVID. And I was like, well, I want to try something different. And I was like, okay, well, I told my wife I found this boot camp in LA on multifamily. So I flew all the way there.
Nothing to do with the Marine Corps.
Nothing to do with the Marine Corps. This is, just a multifamily boot camp. Gotcha. But just randomly went there, and that conference just kind of blew my mind on, that there's a whole different world of real estate that you can scale up on. So, and the,
Yeah. Because I mean, I've listened to Grant Cardone, and anyone who's listened to Grant Cardone for more than 10 minutes, you kind
yeah,
of realize everything. If there's a video about him showing off his jet, it somehow links to multifamily and
yeah,
having
yeah,
multiple doors and all that stuff. So I get that. And some of it is like I can imagine it being hard to scale single family.
yeah.
Like my wife and I just got excited because the neighbors across the street just sold their house and they were moving out, and he was sharing with us what he sold it for, which I'd rather not say. But it was a number so big, and our house is like 400 square feet bigger. So we're like, oh, wow,
Hmm.
we can sell it. But then the problem is now we got to,
Where'd he go?
yeah, where do
Yeah.
we go? And so, the houses are crazy and whatnot, but is now a better time to get into single family with the market being where it is, or is it better to start looking into multifamily, and
Well,
then maybe like what is this Airbnb thing people are talking about? I know that was kind of a multifaceted
yeah,
question.
yeah.
Go whatever
Well,
direction you want.
well, I guess the big thing is how active do you want to be in the multifamily or the in real estate period?
Mhm.
So, a single family, you can pick it up. You're going to put 20% down on a mortgage. If you're good, right now it's hard to make any mistakes. The only mistakes you're probably
Mm.
going to make is on the, if you have to do any repairs, just because contractors are coming in pretty high.
Oh,
But
I bet.
rents going up, mortgages are going down, so you're pretty much good on that. But the difference is how much do you want to be involved? So that's where we go over to the multifamily, where we're actually bringing investors in, and they basically are just silent partners. They put in their cash, and we try to meet our expectations on the returns they get. So, and then we also offset their returns with tax write-offs. That's one thing with real estate is you have a ton of tax write-offs. So you also mentioned the Airbnb. I think that's also a big thing going on right now. We actually have a property in Waco. It's 172 units. There where Chip and Joanna Gaines are. I'm sure if you've ever watched the HGTV show. But
Yes,
anyways,
Waco's made a resurgence from what being known
yeah.
for the when we were in high school, the Branch Davidian complex. Anyway, sorry.
Yeah, true that. It has a better image now.
Yes,
But
yes, yes.
but surprisingly, I mean, there is people there going there for tourism to go see the Magnolia Farms or
Oh yeah,
whatever they're
I
called.
know so many people who have
Yeah.
like from here. Like it's like
Yeah.
it's like they're going to Mecca or somewhere. It's like a
So
pilgrimage to go
we're
see
actually going to
this
convert a
thing.
few of our units to Airbnb and give it a shot,
Oh, okay.
and see where it goes. But you also have the local college there, so when parents
Mm.
come to
Oh,
to
true.
visit
For the
visit
games and
kids or the
yeah.
games, yeah. So we'll see where it plays out. To be honest, so I don't have a lot of experience in Airbnb, so this is one of those things you try it, experiment, and see where it goes.
So some of it is literally just trying and experimenting for things.
Yeah, well, it's
And
just like you said, you have to find a market and you got to play with it,
uh-huh.
and play with it goes back to running a business. What will people pay for rent, or
Hmm.
what are my expenses? You get your expenses down and get your income up.
Yeah. So the interesting thing is, going on a little bit of a tangent here, but this is still related. Going back to the example of like the house across the street. When we were talking about like, how much he sold the house for. We both had kind of like that moment of like, okay, at least we're in positions of like, we bought our houses several years ago, so all this equity is going up, so we really can just transfer the equity to a new house
Hmm.
at the crazy price. But I could see for someone just coming in, like, if thinking back to like when we were like 23, 24 years old, like people were buying houses our age back then, but like right now it'd be very hard
Yeah,
unless you're a
yeah,
heart
yeah,
surgeon to afford a house. So that probably is putting more into the rental market, I would imagine. Is that
yeah, yeah.
true
America,
or
yeah, and I personally think America is going to become a renter nation. First off, people don't want to be tied into a 30-year mortgage.
Mhm.
But there are people that, so it'll see where it goes, but also people want to be able to move around quite a bit. So I think, and also it's a harder entry level to get into, buying a property right now. With inflation going up, the prices are going, through the roof. If you're, late 20s or early 30s, which the millennial generations, and right now,
Mhm.
which is the largest generation after the baby boomers, are trying to get into the real estate game, and it's a hard entry to get into. So I don't see where it's going to go as far as these the real estate going, because everybody's throwing money in. That money that the federal government printed has to go somewhere. So there's a lot of
Right.
investment buying up real estate, and the average person's getting pushed out.
Yeah. And so some people listening to this, know that there's, to your point, all that money that's been printed is kind of making its way into markets, and people are trying to find places to park money. Like the
Yeah.
big thing right now in the Amazon space is there's all these aggregators, which are companies that are buying, smaller brands on Amazon. So there's people listening to this that maybe in a year or two might have, $1 million or $2 that, from selling their business. And then they might be looking to park their money somewhere else. And maybe they're burned out on e-commerce, or, they've got, I know there's a lot of people that do e-commerce that have several other businesses that maybe they want to take money from the cash flow from e-com and put it into something else. So, you started off with a single family home. Is that the way you'd recommend people get started today? Like what is the route, knowing that you've now,
Yeah.
between Airbnb, single family home, and multifamily home,
Well,
how to get started?
well, if you're interested in, you want to own a big property, but you don't want to manage the day to day, and you want to offset your risk, multifamily is a place to go. And that's where you're doing the syndication, where you're just a limited partner, or what we call a silent partner. And you're getting a return back plus your tax benefits on the real estate. That's probably the easiest and most passive way to go. But if you want to get crazier, then yeah, the single family homes, but then you need to do your market research, hire a property manager and all that stuff, and then realize it's going to take some of your time to manage it. So
Okay.
there's
So
many ways to get into this business. Let's put it that way.
So, and I remember we were having dinner last year when you were starting to scout out homes to purchase for like yourself when you're moving
Yeah.
back to the US, to Fort Lauderdale area. And you were talking about how, if I remember correctly, you were like in like 3 different buckets in some syndication deal. Maybe that's the right
Yeah.
term or not. What were those? Because are those like the 3 different avenues somebody might take into a like a multifamily home deal?
Yeah, so like right now, when I first started, so I went from, the single family homes, I did the BRRRRs, the house hacking, all those acronyms you hear on Bigger Pockets,
Okay.
to what we call
Well, just real quick.
Go ahead.
What are those? So I have no idea what you're talking about, and I'm
Okay,
sure
so
everyone, not everyone, probably a lot of people know more than I do, but I'm just
okay,
curious.
so like the BRRRRs is buy, remodel, rent, refinance, repeat. The house hacking is where you're living in a house where you got it a normal normal mortgage, that you're living into it as a house. You fix it up, and then you rent it and you refinance it out. And then the other ones are flips. I've done flips also, where you're buying a property, fix it up, remodel it, and actually sell it for a profit. So I've done all that. Realize, that's a lot of capital on the line to do all that. So then I moved over to what we called LP, or limited partners and syndications, where I was putting, $50,000 into a deal, $100,000 into a deal, where I'm buying in, pooling other people's investors' money, but and bought these multifamily properties. So we got them over Florida, Ohio, Georgia, and Texas. And then from there, I kind of saw how they were running the operations, that we moved over to general partners. So the difference with that is now I'm out looking for the deal, working with the broker, and actually purchasing the property, and then finding limited partners to bring the capital into the deal. And then we give them the returns back. So
got it. So there was the limited partner, which is basically someone who is funding the deal, right?
Yep. Bringing their capital to the deal.
Bring their capital to the deal. The general partner, which is someone who is kind of more overseeing
sweat equity.
it.
Yeah, sweat equity, actually overseeing the property and all that. So these deals are structured under, they're SEC regulated. So we have to get a syndication lawyer. You're signing, memorandums. So it's all legit. I know some people think this is like a pyramid scheme or something, but no, it's regulated. And
so this isn't just like a handshake. Like, well, let's do it.
Yeah, just wire this money to
right,
Africa,
Right,
but,
exactly. Gotcha.
So
okay, so but there was a third route, right? There was the general
Um,
partner, the limited partner, or maybe it was managing something or other.
well, the general partner is a manager. So that, I guess that's
Okay.
really the in the syndication, there's two routes, and that's
Mm,
limited partner or the general partner. So that's what I'm saying, where I've kind of transitioned through this whole thing. But being in the limited partner side definitely taught me a lot on how different syndicators are running their business. From as you know, we'll go to Grant Cardone, where he's doing an equity play, which he's flaunting a lot of money. I wonder whose money he's flaunting, but he's playing the equity game where he's thinking a property is going to raise in value and then sell it in 2 or 3 years. We're the difference, where we try to buy a property, do value add, which then to force appreciation, and then we want to do cash flow. So our point is that maybe the first year or so, it's, we're turning the property around, but we want to give you cash flow every month and have good returns. So that's kind of the difference we are. And I think that will actually be better in a down market compared to, what Grant Cardone's doing in the equity.
gotcha. Gotcha. Okay.
Yeah.
So you're looking to go more the route of cash flow and
Yeah.
people are getting, cash every month. So is that the way most deals are structured in that world, or is that kind of like your uh selling point?
That's our selling point, but I've seen so many deals structured so many ways. I mean, you can structure it any way. Now, to get into the weeds of it, we could do it, a 3-year hold, a 5-year hold, and a 10-year hold. We usually like the long-term holds just because it's kind of playing, it's definitely playing the cash flow game, but we do hope that, with appreciation, there will be a little bit of equity at the end. That's kind of icing on the cake.
Hmm.
But the other way you structure it too is, this is one thing you need to look at your sponsors whenever you're looking at a deal is, what are the splits? Are they giving you a 10%, preferred return? And then now I'm going to get to the actual terminology of it, an 80-20
Okay.
split. So what that means is you're getting a preferred return of 10% on your money, and then whatever's left after that in cash flow is split 80% to the investors and 20% to the general partners. So those numbers can change dramatically on any deal. So that's one thing you have to realize. So it just depends on what you're comfortable with. But when syndications are put together, the general partners will present what's called an OM, an offering memo, and they'll show the property, they'll show the business plan, they'll show the underwriting, what the market looks like is going to do, try to sell the deal. So there's a lot of information out there if anybody's interested.
Yeah, I'm sure. So, someone could go down the rabbit hole
Yeah,
in the e-commerce space, especially on Amazon, with all the like, here's like how you can pick a product and all that. Like, where would someone even
exactly.
begin to look in like this space? So if they had, let's say, $10,000 they wanted to invest into a syndication, or is that even enough?
Yeah. Well, 10,000 is a little low. I think the lowest I've probably seen is maybe 25K.
Okay.
So believe it or not, most syndications around the world are done through family and friends, which under
Mm,
the SEC regulation is a 506B. So that's why you don't hear a lot about them. The only time you hear about the big ones, and that's usually like the Grant Cardones, which is a 506C
okay.
regulation, which by the way it's written is those can be advertised, but only to accredited investors. So
Okay.
506B cannot be advertised, but can be non-accredited investors. That's why you don't hear a lot about this syndication. So it really depends on how the deal is structured. But usually, like I said, most times it's 25, 50, or 100K buy-ins.
Okay. Got it.
Yeah.
Got it. Because I mean, it takes a lot of capital. So, like, what is the cost of, let's say, a apartment complex?
Well,
$10 million, $20
yeah,
million?
I mean, those can go all over the place. We've closed on 2 deals this year. One was $12.8 million. So we had to bring about $4 or $5 million in equity at closing.
Uh-huh.
So the reason for that was this was during COVID. So we had COVID reserves that the bank
Mm,
made you have 18 months of principal and interest so you could pay the mortgage. Then we had capex, so we had to which we brought about $500,000 to renovate the property. And then
And
you have
that's what
all,
CapEx
yeah,
is, like
yeah.
the
And then
renovations. Okay.
legality and all these other stuff for closing, plus, bringing whatever the bank requires, 25% down. So that was that deal. Then we had another deal we just closed on that was about 6 million. So, it's about a $1.5 million cap raise. So it really just depends. So, the bigger the deals, obviously, or the bigger the purchase price, or the value add you have to do, the more money you have to bring to the deal.
Got it. Got it.
Yeah.
So, because otherwise, if somebody has said, "Hey, I want to bring in $500," like
Yeah.
that's not
We're not going to get there anytime soon. So yeah,
right,
we're
right.
looking for people to bring in 100K to 500K. So it really depends. But the one thing I will say, the more money usually an investor brings in, we might structure a deal different and give them better returns. So, I mean, from our point of view, we would like one deal we have like 40 investors. So it's 40 investors we have to communicate with, transfer money to,
Oh
compared to
yeah.
if we had, 10 investors, it's a lot easier to manage that deal. So,
Right, and that's more cost in like writing
yeah,
checks
yeah,
or
yeah.
and communications and all that. So let's just say someone didn't quite have the funds to get into the syndication for multi-channel. There was someone I was copied on where you and him were talking kind of real estate shop back and forth, and he was talking about
Oh, yeah.
syndication almost like something to strive for. So for someone who maybe they're not there yet, but they want to get involved in real estate investing and maybe shoot towards that, where would be the route to go? Would it be more the buy the burrs or the?
Yeah, the one route actually I forgot to mention is the JV, the joint venture.
Mm,
So that's where maybe you don't have the money, but you have a friend that has the money. And
hmm
so the difference is you bring the sweat equity to the deal. You go out and find it. Let's say it's a triplex or, a small deal,
hmm
and you have a friend that brings in the equity or the down payment. And then you guys, determine what the splits will be, 50-50, whatever. And that's another way you could do it, where you don't have any money in the deal, but you can at least get into it. So there's like I said, millions ways to get into real estate, just like probably the e-commerce.
Exactly. There was
You got to be creative.
exactly. You definitely got to be creative. And the thing of it is, like, I saw somebody post recently, like something like talking about with e-commerce, like, you really shouldn't get into the game unless you have $30,000 to invest. I'm like, I disagree,
Yeah,
because
I
I've seen a
agree.
lot of people get in with like almost nothing, like, because there's different
You got to be
things you could.
creative and do something.
Exactly. Some of it
Bring your
is
skill.
bring your skill. Some people like myself to at least mentally get started. I checked out stuff in the um what they call retail arbitrage, where you're
Hmm.
basically scanning stuff like that's on clearance in a store and selling it on Amazon. Quickly I learned that was too much work. And so I went into private label branding. But even private label branding, I don't think you need $30,000 to
Yeah.
start, and depending on what it is you're selling. And so maybe you don't start with selling protein supplements in the e-commerce world. Maybe you have the funds to start with that, or maybe you have the funds to start in syndication. But like, to your point, like, you can always start somewhere and level up, kind of like what you did
Yeah.
back in the day, and you've developed quite the portfolio. So this is kind of fascinating to
Yeah.
hear all
Yeah.
this stuff.
Well,
So any other advice you have for folks
Well,
looking to get into
definitely
the real estate
just
investing
I
game?
think, and this is advice on anything, is educate yourself. And there,
Mm.
like nowadays, there's so much material out there. Listen to Kevin's podcast.
Yeah, exactly.
No, but I mean, there's a million podcasts out there, websites, blogs. I mean, it's the information's out there. So, and people are willing to share it. So take advantage of that. So it's not like you're just taking a leap of faith. So educate yourself and definitely take massive action though. Don't overanalyze anything or you'll never get anywhere. So that's a big thing.
That is so true. And it's true in anything that's kind of entrepreneurial, is you got to get the information, but not over analyze it to death. And you got to start taking action, because at the end of the day, you're going to learn the most by doing. And I'm sure it would be overwhelming if you tried to get into syndication as a general partner, even if you had the funds to do it, because you may not have the experience to do it. But
Yeah.
maybe you could start off and level up and start seeing some certain things, you know, because the more you understand just the way deals in real estate work, like I can say, having bought two houses now, our old house and this house, it was much easier the second time around
Yeah,
because we
yeah, yeah.
learned along the way. And so just with anything, the more you learn and the more you do, the better off you're going to be. And so this is fascinating. So somebody wanted to learn more from you. Where would they go?
So they can go to jcoreinvestments.com. So that's our website. And then from there, we have it's myself and three other partners. So let me just tell you a little bit about our team.
Yeah.
So JCOR stands for Joint Chiefs of Real Estate. So it's a catchy name, but the reason we came up with it, I'm the former Marine, and I partnered up with some other veterans. So we have an Army veteran, an Air Force veteran, and a Navy veteran. So we just all came together with our skills and created the JCOR Partners LLC. And so now we're actually actively looking at deals. We do education with our investors or anybody that's interested. So feel free to set up a call with me. And I love talking real estate and giving whatever knowledge I have. So yeah, take a look at that website.
Okay. And that was jcoreinvestments.com.
Correct.
And, with anything, always do your due diligence. Make sure that whatever you're investing in is something you're comfortable with. But, if anything, just get out there and start learning about different things. And so I was fascinated to, more than anything, just kind of selfishly wanted to have the conversation just to learn a little bit from you, since you've been doing this now for almost 20 years. So kudos to you for all you've done there. Thank you for your service. And it's been great catching up with you over these years.
Well, thanks, Kevin. Thanks for the invite. I enjoyed it.
Thanks.